Hey guys, how's it going? Thanks for coming. I'm Nick, and in this video we're going over the recession of 2008 and comparing it to what's going on right now in 2020, which is possible recession. I will argue about it in this video, and could be possible depression. So what I'm going to be doing is first going over what happened in 2008. We're going to go through what happened during that time into 2009, go over the peak, when it dropped, the rebound, what happened during that time. Then we're going to compare and contrast to now. So let's start off with the basics and the big numbers here. So we're starting off with the recession in 2008, the Great Recession. So it peaked in October of 2007. The Dow was just over 14,000. Now the bottom came in February of 2009, and the Dow dropped just around 6,600. That was actually closer to like early March actually. And during that time, I noticed there were 5 big drops. So it didn't just go straight down, it like went down a big chunk. Then it kind of dwindled, then it dropped again, and then it dropped again. So it wasn't just straight down like we're kind of seeing now, but it kind of took a little while. Now the rebound, for it to get back to our original peak in October of 07, was at January 2013. So now real quick, I just want to break out the timeline, how long it took it for the market to drop, how long it took it to rebound, and how long it took completely the whole drop and the rebound and the whole process all together. It might interest you and might startle you at the same time. So how long it took for the market to drop? Well, obviously you could see the dates here, but I want to write it down so you can actually see it. So the drop took around 5 months to happen. Excuse my handwriting. But it took 5 months, you can see, from the peak to the bottom. Now the rebound from the bottom back up to the peak, 3 years and 10 months. It almost took 4 years for it to rebound from the bottom. Now the whole entire process took 5 years and 3 months from the peak to drop and then to rebound. Over 5 years. It dropped over, well, or around 50%. So you guys might have been familiar with those numbers. So now that we kind of have the basic understanding of what happened as a big picture, I want to look at what actually happened step by step, going through the process of this recession, if it's anywhere near or close to or similar to what might be happening right now. And bam! Here we go. So the first start of the recession, also known as like the subprime crisis, because there were subprime loans going on. So what was possibly the start was New Century Financial. They were a subprime mortgage lender, and they went bankrupt before the peak. That was in April of 07. And then, still before the actual crash, then in the summer, Standard & Poor's and Moody's then had announced a rate reduction in 100 bonds and put 600 securities on a credit watch list. Now it's actually pretty interesting how things started to be a little bit concerning while the market was still increasing. So there was that disconnect. Now, let's go a little bit further. So like we kind of mentioned before, after that we noticed that on October 9th or thereabout, the market did peak at 14,000. Now, the net worth of Americans dropped by around 20%. I did go through a website that had this statistic. I will leave a link in the description if you want to read through the article. That's where I got a lot of these statistics and facts. I'm not entirely sure if that 20% is accurate, because the market dropped by much more than that, but you could also argue people had no money whatsoever to lose, so maybe that averages in. But another main factor, especially because this happened recently with interest rates, what happened with rates back then? So, back in September of 07, rates were around 5.25%. So much higher than it is today. But by the end of 2008, it dropped down to 0. Exactly what's going on now. So I just erased that, but real quick, why they do decrease interest rates. So it hopefully stimulates the economy. People borrow money a little bit more, so people end up spending, and money just is more, it moves around more. But as I looked deeper into what actually happened, the scarier it became closer to what's going on right now. And I'll tell you exactly why, because bam, stimulus package. You have heard of that on the news recently because they did that back then as well. So the stimulus package back then was first announced through GWB, which is George W. Bush, February 2008. What happened was the Economic Stimulus Act, which actually promised taxpayers $600 to $1,200 in rebates. And to look at their perspective, it does make sense. Instead of putting money straight into the banks, which would then have to be put back into the economy, if they give it straight to taxpayers, then they could go and spend it and kind of stimulate the economy a little bit faster. Not saying I agree with it, but I could see their perspective, and that's what happened back in February of 2008. So next, hopefully my handwriting, you could read it. I know it's horrible. You could let me know if you wish. But then the big old Bear Stearns started collapsing, or collapsed actually, in March of 2008. And if you didn't know this or not, their assets were acquired by JP Morgan Chase, which was very interesting too. Then a few months later, Lehman Brothers ended up going under just as quickly. And it was very interesting because within days, so the Fed tried to catch it quick, that the Federal Reserve was looking at the insurance and investment company of AIG, and they pumped $85 billion into AIG because they were too big to fail. That's a common term right now. That's kind of where it started. AIG, if they collapsed, then that could cause a domino effect of other things to come along the way. So that's one reason why the Fed started injecting money into companies just like AIG. And if you thought that was a lot of money, there's still more to come. And bam, that's due to TARP. Now, what TARP stands for, I wrote it down so I gotta remember it. It's Troubled Asset Relief Program. And they announced this in October of 2008. And the reason behind that, well, first of all, that program injected $700 billion so they could buy struggling companies and assets so they don't go under, which causes more problems. Then a few weeks after that, announcing $700 billion, they pumped $125 billion into banks. They also, in early 2009, bailed out General Motors and Chrysler with $80 billion. And by the way, one of the banks that was also bailed out, Bank of America, $125 billion. So next, I'm trying to keep this quick and concise for you guys. So now in January, New Year, 2009, incoming Obama. And the first few weeks of, while he was in office, there was a second stimulus package. So on top of the $700 billion they did a few months earlier, there was an extra $787 billion in tax cuts to help with infrastructure, schools and healthcare, etc. So you will be seeing this in what's going on right now. Very similar, just huge sums of money just being printed out of nowhere. No one really cares at this point. But the downturn officially ended in June of 2009. So that was kind of the main things that happened along the way. And I want to also point out or show you guys some charts that happened. So we want to look at some like interest rates, I want to show you unemployment and a couple things like that. So let's go. So we're first starting off with the federal funds rate. We could see this chart is starting around 2000. You could see that dot-com bubble burst, and then you could see that 2008 recession and all the way up until now. However, you can see that the Fed kind of held rates around 5.25%. Then they dropped. They were kind of stagnant around 2%. That was in June of 08. And then they dropped all the way basically to 0. And you could kind of see that's what's happening right now. Right now, kind of toward the end of the chart, they were steady for, it was around like 2.25%. Then they dropped to 1.5%. Now we're going to get into that in a little bit, but this is what interest rates did during that time. At the same time, I wanted to show you unemployment. So you've noticed that, in the news recently, a lot of people are talking about, all-time low unemployment. Well, I mentioned this in a couple of videos prior, but I gotta mention it at this point because before every recession, the unemployment rate is at an all-time low. And you could see that in this chart. So going back to the 80s, 90s, and 2000, so you could see, unemployment shot up, and then it, just trickled back down, all-time lows, and then a recession and unemployment skyrockets. And then it goes back down, you could see in 2008. Then it spikes right back up, and we are trickling back down again. And interestingly enough, by the way, the bottom of the Dow was in February, yet unemployment peaked in November. So although the Dow bottomed out, unemployment was still rising. So the market was actually starting to rebound while unemployment was increasing. So that's something to think about as well. So now, time to compare and contrast what happened in the recession 2008, subprime mortgage crisis, to the recession in 2020. I will argue that we are going into recession. A lot of things point to that, just because it's very similar to back then. Now the question is almost, is it a recession or going deeper into a depression? I don't want to fearmonger, don't want to be negative, just saying this is certainly possible. Anyhow, let's first start out with the peak of the Dow. This happened around, let's say, mid-February, around the 12th, and the peak was at 29,551 points in the Dow. Now, I don't really see us getting close to that mark anytime soon, honestly. At this point, there's no real bottom in sight. There are 1,000, 2,000 point, I believe there was a 3,000 point drop in a day multiple times, 10% in a day, and it's just crazy, matching drops back to 1987 during that crash. So the bottom, really, no one sees that because it keeps breaking new lows. We are already seeing stimulus packages for taxpayers and businesses. Right now, they are talking about a stimulus package for us. So for every taxpayer, for every adult, I believe I have recently heard a check per adult is $1,200 and per child is $500. And that kind of diminishes once you start making more than $75,000 a year. So along with that, if you guys have no idea what the repo market is, it's basically overnight loans between banks that need liquidity. They need just things to stay open for operations and everything like that. Now, the Federal Reserve is pumping $1 trillion, no longer $1 billion, that's too small, $1 trillion every single day into the repo market. Now, like we just saw before with taxpayers, that's around $500 billion. And by the way, this is just of, what's today's date? This is just of March 20th, 2020, because at this point, anything could change. These numbers are probably going up. But anyway, the checks to the taxpayers are around $500 billion. Now, the bailouts and the injections of all this stimulus money are going into, one we just talked about, the repo market. They're talking about bailing out cruise lines, airlines, hotels. One large company a lot of people are focusing on is Boeing. They're an aircraft manufacturer, and the Fed is, I forgot the number, I know it's at least $50 billion into Boeing alone. So let's talk about what's going on with people's jobs, their careers, and their work. So obviously you guys have heard all over the place, I'm not going to say the word, but the sickness going on, basically everything shut down. You can't go anywhere, just the essentials, you know, like grocery stores, healthcare facilities, and all that type of jazz. Now, that's with work. Now, small businesses, first of all, a lot of them are just closing down. No one could go there. So what's going to happen to them? And we didn't even talk about unemployment yet. We don't have those numbers, but I have heard, I forgot where, Steve Mnuchin might have mentioned, not going to say anything about that guy, but he mentioned, is it possible that unemployment could skyrocket to 20%? Back in 2008, unemployment was, I believe, maxed out at like 10%, and that's going by their numbers, by the way, which are questionable. However, unemployment hasn't spiked yet, and it's definitely going to start because now small businesses are going to get hit. You know, they cannot provide a salary to their workers if money isn't going into their businesses. So that's going to be a huge problem, and that's why I believe this is just the start of it. Next, we can look at the Fed rates, what they've been doing. We could go back to that chart if you wish, but it was going back to just over 2%, then they dropped to 1.5%, then there was an emergency rate cut of 1%, and then there was another emergency rate cut all the way back down to 0%, just like the recession in 2008. So if all this stimulus, all these bailout talks, all this rate cuts, if you don't think we're in a recession right now, I would argue that's delusion at this point. If this was a normal economy, none of this would be happening. And yes, the illness is a major factor. This could, a lot of people are getting destroyed by this, unfortunately. The spread of it's ridiculous. However, all of this stuff is going behind it. The Fed is kind of, I don't want to say like this is, they're using it as a scapegoat. I mean, they kind of are. But all of this stuff is going on right behind the illness. When everyone's focusing on just that, there's all this talk as well. They are different situations. It's not just because of the illness. The illness caused this. It was the pin that pricked the bubble. But now, since the economy was kind of all screwed up, now we're feeling the effects of it. Now, at the same time, I'm getting worked up because it's ridiculous what's going on right now. So we'll try to calm down. But I can't, because other countries, now, America is at 0. Other countries are at negative interest rates. The big problem, that's horrible, but liquidity is one of the biggest problems right now. And that's why they're just injecting so much money into the system, into the banks and everything like that, into the repo market, because liquidity and cash isn't available. And, we haven't seen any bankruptcies yet, which are certainly possible because that's what happened in 2008. Why do you think they're trying to bail out some companies and even industries? Because they could go under. And what happens if they go under? Then just more of a domino effect then just takes place. So if there's a liquidity issue, institutions start liquidating other assets. So bonds, corporate bonds, basically anything, and they're starting to do that. The corporate bond market is getting hit. I will pull up a chart for you now so you could see that. And this could cause a credit freeze. Again, I don't want to fearmonger any of this. This is looking at things realistically, because this has happened in the past. History is very similar to each other. So if liquidity dries up, then there could be a credit freeze, because now not many people have cash available. So now we have to bring it back to you. What does any of this matter to you? Well, I believe a lot of it could go back to interest rates. That could affect you. But I think a huge thing, what I think a lot of people aren't even thinking of yet, is that liquidity. So this has happened in multiple countries in the past, and no one's really focusing on them because it is possible. This happened in Venezuela. This happened in Hong Kong. This happened in Lebanon. And there could be a run on the banks. Again, this is a possibility. And I want to put it out there because I don't want to just not care about it and then not get people prepared, because it could happen. So what is currently happening right now, which I just learned about this and it's almost terrifying, that banks, sorry, it's kind of getting crowded, so I'm trying to narrow this down a little bit for you. But banks used to have to carry 10% on reserves, on cash, just in case, people have to take money out of the bank for overnight operations. They need cash on hand. It used to be 10%. Yes, used to be, I said, because now, when is it? Effective March 26th. Banks no longer need to have reserves in their accounts. They have 0 reserves on their accounts, which means if there is a run on the banks, which is certainly possible, because now people are starting to think what could go wrong. They want to prepare as much as they can. Silver and gold are basically being bought up. They're sold out everywhere. Their premiums are all over the place. If you are interested in that, I did go into a video of gold and silver. You can check that out. However, if there's a run on the banks for people to get cash out, they don't have any, because they're at 0% very soon. And that means there could be a financial crunch, a credit freeze, which means your debit card might not work, your credit card might not work. I have heard that people's credit limits are decreasing. It's not confirmed. I have heard of that though. And cash at ATMs could no longer be available. So if you want to get cash out of your bank, that might not be possible during this time period. Due to those reasons, with all these injections, all these rate cuts, all these bailouts, we are in recession. And I could argue, and probably will argue, back in 2008, things weren't fixed. They were bandaged up, and the problems we had back then are still the problems we have today, because we are back at 0 interest rates. The Fed was supposed to be buying all these assets, all these bonds, to eventually sell them down the road so things get back to normal. Well, now, I erased it, but now we're back up to $1 trillion being injected into the banks. I'm getting exhausted because all of this is just nuts, and people are just focusing on one area when there's a much bigger picture involved. And it's really concerning, honestly. And people are trying to buy the dip. Like this recent rally, every so often there's a rally. The Dow might be up 1,000, might be up 1,300, every so often. We're in a bear market right now. And those rallies are almost, I don't want to be harsh, but they're sucker rallies. It rallies for a little bit and then it just crashes back down. Rallies a little bit, then it crashes back down. That's how a bear market is. Nothing goes down in a straight line even though it kind of has. But you know, it drops. Maybe a little blip up, then it drops again. And that's exactly what's going on right now. And eventually, there could and most likely will be a flight to safety because of all this. You know, people could, like we kind of just said before, they could take cash out of their banks when banks don't have that. People could be buying gold and silver, and when I say could, they are, because that's a fact. All the websites that are going, like JM Bullion or SD Bullion or goldandsilver.com, they're basically all sold out. And people are going into these safety assets, safe havens, because one issue could be hyperinflation, because they're printing so much of this money, then the value of your dollars goes down. That's why other things could go up in value, because your money is decreasing in value. And that's why I get so furious of all these bailouts that no one's focusing on, hundreds of billions of dollars, which is decreasing mine and yours dollars. At this point, so many people are down like 20-30% at this point. I don't even know how much. You know, last recession, it dropped 50%. And if nothing was fixed, then now we could still drop even more. Unfortunately, a lot of people are getting hurt from this. Now, people could get destroyed if they're about to retire. Now they can't. People are losing jobs. They're getting laid off because of all this. You know, another issue I didn't even talk about, what if interest rates go up? What if that happens? Or, you know, if we do go negative, we're gonna have to pay the banks to hold our money. No one wants that. What if interest rates go up? What if you have a variable rate loan, which a lot of people could have? Then your payments double or triple in price. The fact that all of this, whether it makes sense or not, I tried to kind of condense it a little bit. I know this is going to be a long video, so I appreciate you guys hanging on, but this is serious, because this affects lives. This affects your money, because some people might say money's not everything. Well, look at it now, because you need money to live and survive. So I know this is probably not going to get a lot of views, but if you do put it out there, I did want to explain the similarities, because there are a lot of them, of 2008 and 2020 of right now. I think the biggest question is this going to be a recession or a depression? And I really hope that it's not. I hope we make the best of it. I hope this is all garbage. I hope none of this happens. But unfortunately, I really do think it will. So if you guys have any questions, comments, concerns, please leave them down below. I love to hear what you guys have to say. I am going to make another video, because that is a big question of depression. I'm going to make a video comparing 2020 to 1929, which was the Great Depression. So I'm going to do some research and try to find some similarities and compare those. So if this video helped you out, give me a thumbs up. Don't forget to subscribe, and I'll see you guys in the next one.